There are some similarities between all derivatives contracts, such as forwards and futures. So what are the similarities between forwards and the futures? In each contract, we must have some major characteristics, such as we specify in the contract the quantity, the price, and the time, which means what is the quantity we would like to buy and sell in the future, at what price, and what's our maturity date or expiration date. And the market participants are usually either hedgers or speculators, either individuals or companies that they have a level of risk and they would like to minimize it or eliminate it, which we call it hedging or hedgers, or market players who enter the market just to make higher profit by taking higher risk, which we call it speculation. So these are the similarities. Now let's talk about the differences between forwards and future contract. So in forward contract, it's considered private contract. What do you mean by private contract? Private contract, it means that it's a direct relationship between the buyer and the seller. So the buyer will promise to pay a certain amount of money in the future to the seller, and in the future the seller will promise to sell a financial or a real asset to the buyer. Therefore, they don't have any intermediary. Both the buyer and the seller, they know each other. But for future contracts, it's considered public contracts. What do you mean by public contracts? This means that this is indirect relationship between the buyers and sellers. It means that if a buyer would like to buy any real or financial asset, they will go to stock market and buy it from stock market through the clearing house. Therefore, the stock market or the clearing house will match the buyer with the seller. So the buyer doesn't know the seller and the seller doesn't know the buyer. Both buyers and sellers give an order to the stock market and the stock market matches them. And that's why in the future, at a maturity date, the buyer will give the money to the clearing house will give the money to the seller, and then the seller will give to the asset is a real or financial to the clearing house, and the clearing house will give it to the buyer. So let's make a detailed comparison between the differences of both forwards and futures. We said that forward contracts are considered private. What do you mean by private? A direct relationship between the buyer and the seller. Both buyer and seller, they know each other. Future contracts are considered a public contract. What do you mean by public contract? It means that there is an indirect relationship between the buyer and the seller. The buyer doesn't know the seller and the seller doesn't know the buyer. Both buyer and seller have an intermediary, which is the stock market or the clearing house. Therefore, in order to be able to trade the futures contract in the market, so this means that this contract must be standardized. What do you mean by standardized? It means that they must have the same template, and that's why they can easily trade it. But for forward contracts, these contracts are private contracts, which means any two persons can sign a contract. Therefore, they can put whatever the conditions they want. Therefore, for forward contracts, it's considered customized or tailored. You can write whatever the condition you want in the contract. Therefore, for futures contract, it is exchange traded. It's traded in the stock market. But for forward contract, it's a private contract, and that's why we call it over the counter, OTC, which means privately traded. We don't know about these contracts. Therefore, which one will have a higher credit risk, or we call it default risk or counterparty risk? Okay, credit risk, we call it default risk because we are afraid that one party of the two parties in the contract will not honor their agreement. Therefore, we can call it default risk. They will default on their commitment. Or we can call it counterparty risk because I am one party, the other party is called counterparty, and that's why we can call it credit risk or default risk or counterparty risk. So with forward contracts, because it's a private contract, so maybe one party in the future will default, will refuse to exercise the contract, and that's why it will increase the credit risk or the default risk or the counterparty risk. Yes, forward and futures contracts are binding, which means you will go to the court and force them to exercise the contract, but this will take time. That's why we have a high credit risk. But with futures contracts, we have a low or zero credit risk. Why? Because all the time you deal with stock market. So even if one party defaults, you are committed with the stock market, not the other party. Consequently, which one will be highly liquid? What do I mean by liquidity? Easily to convert to cash without making a significant loss. Which means which contract is easily to sell in the market? To sell the future contract or the forward contract? So futures contracts will be highly liquid. Why? Because they have a low risk, so you can sell it in the stock market easily. But for forward contract, it's a private contract. We don't have enough information about it, and that's why it will be less liquid. So which one should have higher supervision from the government, from regulators? The one that's traded in the market, in stock market, the public contracts. Therefore, futures contracts will be highly regulated, while forward contracts will be unregulated. Therefore, we said that in futures contracts, it means that we have an intermediary, which is the stock market or the clearing house. Let's assume that in the future, the price decrease. If the price decrease, buyers make a loss, sellers make a gain. Therefore, a buyer might say that we are not going to buy because we made a loss. Then you need to take them to the court. So what will happen with future contract? It means that buyers buy from the clearing house and sellers sell to the clearing house. So this means that the stock market or clearing house, will they incur any losses if one of the parties refuse to exercise the contract? The answer is stock market will never make a loss. Therefore, what they will do is the stock market or the clearing house will ask both buyers and sellers to update their position daily to avoid any losses, which means if a buyer will make a loss, they will ask the buyers to deposit the amount of the loss they incur. If the seller make a loss, they will ask the seller to deposit the amount of the loss they incur, and they update the position on daily basis. If one day they make a gain, they can withdraw this amount from their account, and this process is called marking to market. Therefore, who is going to have marking to market? It's futures contract, but for forward contract you don't need to update your position on daily basis. Therefore, which one will ask you to make a deposit whenever you make a loss? It will be futures contract, which we call it performance bond, but with forward contract you don't need to make any deposit. Therefore, this would be some types of risks of futures, because they might ask you to deposit a certain amount all of a sudden, and this was because there was a change in the market price, not in your favor, and that's why you have to deposit it on the same day.